All right. Well, thanks everyone for bearing with us. We haven't done a webinar in a while, so, you know, got to shake off the dust. But welcome and thank you so much for joining us. For those of you who don't know us, or if it's the first time seeing our faces in a while, my name is Emily Gusto. And then I'm not sure if your view can see just me or if you can see everyone, but Danielle and Amanda are also on video at the moment. I don't know if David is or if we're
Sarah,
working. We're
I
working on
can
it.
see David. Yeah.
There he is. Okay. So we're all here, and we are the four of us co-own Propel Financial Advisors together. And the purpose of today's webinar is to discuss the current state of the market, including how we got to this part or to this down cycle, as well as a positive, some practical perspectives on how to handle it and how to respond to it. So the title of our webinar, we refer to this period of recovery. And so basically what we're referring to is just, we're generally speaking about a market cycle. Market cycles include periods of recovery, followed by down cycles, followed by periods of recovery again. And so let's see, it's really nothing new. The reasons we got here are different, and Amanda's going to get into that in a little bit. But we just wanted to remind everyone that we've seen multiple market cycles throughout our careers, and we've learned a lot of things along the way. So that's why we wanted to focus on sharing with you today. So the four of us were talking the other day about other recent down cycles, and Danielle reminded me of in March of 2020, the beginning of the pandemic, which seems so long ago now. The S&P fell to about 34, or fell about 34%. And before that, the fourth quarter of 2018, the S&P was down about 14%. So that's closer to the numbers that we've seen recently. And so they're kind of just blips on the radar. I don't know if anyone else remembers those or can just rattle those off the top of their head. So I just wanted to bring that up to remind everyone that, we've recovered before, we've been here before, and there's really no reason to panic. And then before we get into everything, just a few housekeeping items. I'll be monitoring the chat in the question box, so please feel free to type anything in there, any comments, any responses to what we're talking about. We have a few sections throughout the presentation where we hope to answer some of your questions live, and then there'll also be some poll questions in between the presentation. So we hope you'll participate in those as well. And then for compliance purposes, I need to say that this is an educational webinar, should not be taken as investment, tax, or legal advice, and past performance is no guarantee of future results. So if we jump over to the agenda slide, there it is. So today's agenda, we're going to start off with Amanda discussing why the market is down, so what's different this time in this down cycle, followed by a discussion about investor response, what we've heard from clients and what we hope to hear from you. Then David will cover some points about potential tweaks you may want to consider to your portfolio, just kind of overall strategy. And then finally, Danielle will leave us on a positive note with some potential opportunities. So I'm going to hand that over to Amanda.
Okay, thanks, Emily. So like Emily mentioned, I'm going to cover some of the major themes that we're seeing in the markets right now. I do have, there's a sort of a lot going on, so I'm going to do my best to cover a lot of the highlights here. So you can see here we have Powell. So the Fed has been a major driver of market movements lately. The fact that this is a midterm election year, I'll show you how that causes a lot of volatility in markets. You may have noticed the price of gas has been going up along with other inflationary forces. And this is, I didn't want to put a picture of Putin in my materials. So this is a picture of a dog that sort of looks like him that's been circling around on the internet, if you might have seen it on Facebook or something. So before we get started, here is, I just want to point out that these market downturns just happen, just like the rain comes down, as Milli Vanilli once said. So we're in the third year of a bull market. That's typically the weakest year. And also last year, we had a greater than 20% increase in the stock market. Whenever that happens, we always will see a decline the following year. in here, this is just sort of a funny story, but it does have some relevance. This is Hank the Tank. He's a 500-pound bear that lives outside Lake Tahoe in California. And so earlier this year, there was an increased number of break-ins in people's homes. And so everybody blamed Hank the Tank. And the US Fish and Wildlife Service said, it's okay, you can shoot Hank the Tank now, he's becoming a danger to people. But what it turned out was it was actually 3 other bears who were causing the break-ins, and Hank the Tank had nothing to do with it. And what does this have to do with markets? This is just showing you this is a general human response to things. When people get afraid, they want to blame an easy target. And sometimes the real situation is more complex. So hopefully today I can show you some of the more complexities that are going on. Okay, so here we've alluded to the down market recently. So here's the numbers. It's not pretty, but since New Year's Day, you can see here the bond market, normally a source of conservative and easy returns, it's down -5%. The international markets, this is excluding the United States, was doing okay, better than everything else until here. You can see at the end of February, this is when Russia invaded Ukraine, it sort of fell off. The S&P is down more than 8%. The total US stock market, which would include the small and mid caps in addition to the large caps, is down even more, 9%. And the tech sector has been hit particularly hard this year. It's down 15% so far. So because of that ugly chart, I put in a cute picture of
What the heck?
my 4-year-old saying, what the heck is going on here?
What the heck?
Sorry, it plays again before I advance the slide. So here, I mean, before we get into it, I do want to take a quick step back. This is the market from the past 5 years. You can see actually everything is positive. People have made a lot of money over the past 5 years and longer. So please don't lose sight of the bigger picture when we are talking about these short-term factors. So I don't want to get into the weeds too much on these financial metrics, but I'll just say that the PE ratio, this is a measure of stock valuations. So when this number is high, we can say that the stock could be overpriced. If this number is low, we could say the stock is underpriced. And so historical average since 1950 is 19.8 is the price to earnings ratio. And you can see here's the recent bottom of the last financial crisis. We've had a steady increase in the price to earnings ratio of stocks until 2021. It really peaked and went over this standard deviation of this measure. So when these stocks got overvalued, we are due for them to come back down to earth. And then here I wanted to begin to talk about interest rates. Interest rates affect the price of stocks by the PE ratio. And this interest rate is set by the Fed. And so when the COVID pandemic started, the Fed reduced interest rates to 0. The Treasury printed a lot of money, and we knew eventually we were going to have to stop with that easy monetary policy, but nobody knew exactly when that was going to happen. So if we look here, we can see this is a chart from the Chicago Mercantile Exchange, and this is their expectation of how much the Fed will hike the interest rates in March. So since the beginning of the year, you can see the green line is the expectation that there would be no hike. So at the beginning of year, that was almost 50-50 that there would be no hike, but you can see that falls off over time. January 26th, the Fed indicated that it definitely was going to raise interest rates. So the probability of that happening fell off. But when that fell off, the probability for a 50 basis point hike, that's the orange line, 50 basis points means 0.50%. That starts to go higher. But then a couple of weeks ago, Powell testified before Congress, and he explicitly stated they intend to increase interest rates by 25 basis points. You can see that probability takes off. And so And then yesterday, if you saw in the news, the Fed actually did raise interest rates by 25 basis points or 0.25%. And so these interest rates, ups and downs, and expectations of what the interest rates are going to be, that is feeding into the stock prices, and the expectations on the rates going up and down was contributing to a lot of the volatility we've seen in the stock market. So what the stock market does like is stability. The stock market is forward looking, we can't see the future, but that doesn't stop people from trying. And so the Fed has noticed this instability, and they have explicitly stated that they're going to avoid adding uncertainty. They're going to go out of their way to be extra clear with their intentions. And so at the announcement yesterday, they said there's the 25 basis point hike, and they also expect 6 more rate hikes this year and 4 more hikes in 2023. But even given that, we still don't know what is going on with the Russian invasion of Ukraine. When is that going to end? How will that end? How that's impacting supply chains the longer it goes on, the bigger of an impact it could potentially have. And then could that affect what the Fed is planning to do going forward? So talking about the bond market, I just want to give a quick lesson on bonds. I know different people on this call have different knowledge levels on these types of things. So when interest rates are going to rise, which is what the Fed is going to do, that's going to cause our bond prices to fall. Excuse me, I advanced on accident. And then if the bond is a short duration or short time to maturity, you just hold it for 1 year, that's going to have a smaller effect on the bond price than if you have a longer duration or a 10-year bond. And so also this visual assumes that the longer your bond is, you're going to have a higher interest rate. And as we'll see on the next slide, that is not always the case. So this is one of these like big financial slides that I would have just totally glazed over back in the day and not have any idea what I'm looking at. So I'm going to walk through this one a little bit slowly because I don't want people to totally space out. But here we're looking at the 10-year treasury note. So that's longer. So we want the interest rate on the 10-year to be longer, say 3%, compared to the 2-year treasury real, which we want to be smaller because it's a shorter duration. So say if the 10-year was at a 3%, the 2-year was at 1%, then this is a measure of the spread or the difference between them, which in my example would be 2%. So that's represented by the blue line when the 10-year interest rate is higher than the 2-year. And when the 2-year goes higher than the 10, it's what we call an inversion. And so you can see here, inversions become an issue because they lead to recessions. So we have the red inversion, the gray box indicates a recession. So we get an inversion, recession, inversion, recession, inversion, recession. And right now, this chart is from March 4th. I did look it up this morning. This has fallen to 0.24%. And so there's fear if the Fed raises rates, they're going to trigger this inversion and then which could lead to a recession. And just when the Fed does raise rates, we're raising the shorter end of the treasury market. Okay, and then here to get into inflation, I called this Space Oddity. If you know the David Bowie song, Major Tom blasts off into outer space and ground control loses communication with him. So if we think of the Fed as ground control and Major Tom is inflation, we're going to hope that the Fed can keep Major Tom in the loop and he's not sailing off into outer space too much. But as far as inflation, there's a lot of factors driving it, especially lately with COVID. We've seen an increase in the prices of goods, especially. A lot of times in the news, they report the CPI or the Consumer Price Index. So this chart breaks it down, the inflation between goods and services. And the goods inflation has been driving a lot of that inflation lately. You know, you've all experienced this probably, when everything is shut down, you can't spend money on services. You can't go out to eat. You can't use your daycare. You can't pay for travel. So services saw a big down, but a lot of people were spending money on like home improvement projects or other stuff. So that's why we see the spike here in the blue line, which represents the good side, and services you can see is starting to creep up, and the services line side of inflation is what can be more sticky and get inflation to stick around longer. So yes, so we have supply chain driving it. We have monetary policy, the Treasury printing a lot of dollars. And then recently we have spikes in the oil price, which I'll get into in a second, driving inflation. We also just want to say that if you do have a lot of cash on hand, now is a good time to do financial planning, because for the past 10 years or so, inflation has hovered at little less than 10%, but with inflation spiking, that's making the value of your dollar go down all the time. So we know you do need to have cash on hand for, short-term expenses and that type of thing. But Danielle will get into some financial planning things later in our talk. So
Amanda, I think you meant to say 2% on inflation, right?
yeah, what did I say?
You said 10.
10. Yeah, no. You would all notice if you're at 10. Yeah. And I think that's the Fed mandate, is to keep inflation at 2%. And they hadn't been hitting that target for years. And they were getting flack for not doing that. And so now, now they're getting flack for getting it too high. But raising interest rates is one of the ways that they can help bring down inflation. So hopefully that comes to pass. Then as far as oil typically really hurts on inflation. It hurts people's pocketbooks. It hurts businesses' pocketbooks as well. But JP Morgan recently did an outlook on the impact of this change in oil prices. And they don't think this is going to be as big of a deal as it was in the past. They said the United States has become a lot more self-sufficient. We used to import a lot more natural gas than we do now. Now we're neutral. And also in the past 10 years or so, people in this country have gotten a lot richer. So the share of their income they have to spend on gas has gone down. And we've had increases in energy efficiency in our homes and our cars and other things like that, that should lessen the impact, hopefully. Okay, this I just want to point out, if anybody is worried about the amount of Russian exposure they have in their portfolio, this is something we can pull for you. I just did a sample portfolio compared to, say, worldwide. You could say the sample portfolio has less Russian exposure than the rest of the world markets. But I just want to let you know that's available if you want to look at some different metrics aside from performance numbers. And then finally, earlier I mentioned it's election year, so I'm not talking about presidential election year. This is midterm election year, or like the Winter Olympics, not the Summer Olympics, right? So for whatever reason, the midterm election year is a highly volatile year. I mean, year 2 of a president's term. You can see here back to 1950, we get these large red negative numbers that happen this year. And then after the election, within a year, we see these really large gains come through. This is a pattern that's been repeating itself since 1950. We say here, past results are no guarantee of future returns. That's always true. But 70 years of data is hard to argue against.
I just interrupt. I think it goes back to your point earlier that the markets don't like unknowns.
Yeah, right. So, what is Congress going to look like? Are they going to pass corporate tax reform? Are they going to do anything with Build Back Better? A lot of that, could impact the stock market. They'd rather just know what it's going to be, right? Here, this chart shows standard deviation. This is a measure of volatility. You can see here in the second and third quarter of year 2 of a presidential cycle, what we're entering in now is some of the highest volatility that we see in the markets. So I know it's been a rough year so far, but please don't expect it to change anytime soon. And these are just averages. So it does change year to year, but on average, it's very high. Okay, and finally, as if this is maybe one of your first downturns, or maybe it's your 10th and it still doesn't feel good. Just remember that it comes with the territory. It's sort of the price of admission of investing in the stock market. And at the end of the day, it is individual behavior, investor behavior, that is the biggest predictor of your financial outcome if you can meet your financial goals. So if you are feeling nervous or scared, please reach out to us. Let us know. If you have questions, beyond what we addressed today, we're always available. I hope this is me with a plant. Hopefully I look very approachable. I'm happy to speak with you about any of these things that we've spoken about today. I do have a poll question I'm going to try to launch. So this is about where you get your financial news. Did it launch for everyone? I think I did it right. I see something coming in. I think the SEC has all these rules and laws about what financial advisors can say in their advertising materials. Mostly that we can't say a whole lot about investment advice because we don't know you as individuals, when we're doing an advertisement, so we don't know what's right for you. Which makes sense, right? Except for people who are not professional financial advisors, who do not have an education or background to give advice on it, can give this type of advice in advertisements and other places. So there is sort of a void out there of rational, advice that's in your interest. So I just like for people to keep that in mind. So it looks like nobody's listening to mortgage brokers, and people are reading our website or other materials, which we appreciate. We always love to hear feedback if there's a topic you're interested in that we can address.
Can't see the results. Can anybody else see
Oh,
them?
I'm sorry, I can see it. I'm going to end the poll
Thanks.
and share.
There we go.
Nice.
So this is not, you can answer, I think you could pick more than one thing. So I don't know if people did that, but
It was interesting to see.
yeah, I'm always just curious.
Great.
Right.
So if we're going to move into the next section, we haven't received any questions. So if anyone has anything
Don't
they
be
want to share,
shy.
yeah, don't be shy. Add them in right now. But if anyone is working on that or thinking about it, Danielle and David, what have you heard from clients recently about, or have you heard concerns from clients recently about the downturn?
We've heard some, and I think I'm going to talk about a little bit in my talk. And this is the part of the webinar where we want to leave a little space for, Amanda has shown you a lot of the economic indicators we look at, pay attention to. These are not always the ones that are in the news or the ones you may be thinking about. So we want to have a little time here to kind of focus a little bit on what our clients are thinking or what people on the webinar are thinking. If you have something on chat or you want to add to it, let us know.
And I think I've always got the same kind of couple people who get very nervous during a market downturn, and we have some very long conversations, and I'm happy to report that at the end of it, they usually say, I feel better. So that's good. I feel like I'm doing my job. And others are a little more like, well, what can we do? And I'm going to talk a lot more about that near the end of this webinar. But I always think of it as an opportunity time. That's our job. It's sort of the American way as well. When the going gets tough, what can we do to make this better? Lemons and lemonade, that sort of thing. what I think is interesting is we're going to be showing you lots of graphs today, and there's always different reasons, but when you pull back from those individual reasons, you can still see patterns. And I always find that just an interesting part of what we do, if you can keep the emotion out of it.
I things, I've read everything from, I looked at my account, it was way down. I decided to quit looking at it for a while. To I can't take more of this. This is enough. What can be done to make sure my account doesn't go down more? That second kind of reaction is, I'm going to talk about it a little bit more, but just to indicate that we've heard it from people, is maybe you were being a little risky and thought you could handle risk, when we discuss it or when you think about it logically, but when the risk hits, you feel different. And, that's an indication that maybe your risk tolerance needs to be reassessed, and we need to take a little different approach with your portfolio. But we get that full range of, it's okay, I looked at it, but I'm not even going to look at it for a while, to that, let's do something about it. And that's why we like to give you our cell phone numbers and or respond to your emails or however you contact us, so we can dig a little deeper with you.
Yeah, and just from my own experience, I remember when 2008 happened, I'd only been in the industry for like 10 years, and now I've been in almost 25 years. And in my perspective and how I feel about it based on my experience has changed, quite a bit. I don't get as nervous as I used to. I might get a little annoyed or like, dang it, I wish I had known this was coming. I could have prepped better to take advantage of it. But I don't get as worried as I used to. And as a reminder, we all have portfolios that we invest just like yours. So we're going through the same pain that you are. And just want you to keep that in mind. If nobody has any comments, is this chat box working? Everybody's so quiet.
Yeah.
Oh, here's one.
Oh,
Got one. All right, Colton says it's great to hear and see real data and statistics rather than subjective opinions on Facebook. What would be a normal time frame for seeing the market go down further once interest rates have peaked, i.e. interest rate increases to be expected to leave the market down for months or years? Obviously, that'd be a guess. And yeah, it's a guess. I mean, I feel like, the last 2 days, the market's been way up. I mean, it's going to close here in about 25 minutes. And after the last 2 days, like small cap growth, for instance, is up almost 8% in 2 days. And I'm going to talk a little bit more about some volatility here as we go on, but those highs and lows are getting much bigger. There's reasons for that. We're not going to delve into it too deeply, but I think that some of the rate hike is, like Amanda said, a relief. It's been something we've been waiting for, and it's just been like, well, will they or won't they? And now that we know, we can address it. And they were, she said at the beginning of her presentation that Chairman Powell said he wanted to be a lot more transparent, and they were. I mean, he said they want to do 6 this year, 4 next year. That's not typical. That's not what they typically say. And during COVID, they were very tight-lipped, because they, quite frankly, just didn't know where it was going to go. I think that I think it's a good thing if returns temper a little bit. These huge highs and these huge lows are exhausting. They're just difficult to keep up with. It's hard as an investor to follow it and to know when to zig and when to zag. So something that comes down a little bit, I think, would be a relief. And maybe that is something that we'll see as a result of these rate hikes. We don't have lots of history with consistent rate hikes. It's just not something that we've been at. We've not been at zero that often in the past, back in 2001 and now, and that's really about it in my history. And David probably remembers something else, but it's not something we have a whole lot of experience with.
Nobody knows how long. That's a tough question there, because nobody knows. You can't predict the future. I think we hear from a lot of financial analysts and strategists that because of these uncertainties that Amanda mentioned, they are real uncertainties. What's going to happen in Europe and Ukraine is a real uncertainty. What's going to happen with inflation and these supply chains that don't seem to be correcting? You may remember a lot of people heard from the Fed and other knowledgeable leaders that the inflation was going to be transitory. Not looking so transitory now. That's an uncertainty on how that's going to linger and what it's going to take care of it. So a couple quarters would not be at all surprising. I remember the dot-com bubble. Danielle remembers the dot-com bubble. That was in 99 and 2000. The bond market outperformed the stock market then 3 years in a row. That was a long, a somewhat painful recovery if you were not in the bond market as well as the stock market. We don't expect that, but that's how bad it can be. And by the way, when that happened, that the bond market outperformed the stock market for 3 years in a row. That was the first time that had happened since 1927, and it's not happened since. So we're not predicting that what happened, but we don't exactly know the answer to that question. Is what we should say clearly.
Yeah, since we started a few minutes late, I think we should move forward with David's section. Speaking of
Okay,
uncertainty.
thanks, Emily. Hi, everybody. One of my favorite places. I have to put the picture up. This is Monument Valley. If you haven't been there, try to get there sometime. It's a beautiful place. But here, this picture, it's not clear when you first see it. Is this a sunrise or a sunset? And so it represents some of that uncertainty. Now, if you've been there, I was there with my daughter Julie when she did a half marathon running around these buttes. And so I know the direction from which this picture was taken. And I see left mitten there, that little thumb sticking up. And so that's actually a sunrise. And I hope that's what we're looking at today. So are you doing the slides, Emily? Yeah, there you go. This is the long term. Notice how music is switched. This is something I requested, and everybody knows I like. These are going to be country songs now instead of just 80s song. I was in the stream, you may remember, with Dolly Parton and Kenny Rogers doing that. It was a great song. But market corrections are normal. We've said that patience is usually the best response. There's that .com bubble. We've marked it on the chart. You can see it went down there for quite a while, and it took a while for it to get back to where it started. Some people call that the lost decade in the stock market. But if you had bought in at that high in 2000, right at the top of the .com bubble, look where you'd be today. Way better off. That's 20 years from the .com bubble to today. And then the subprime mortgage bubble was pretty steep, and took a little while to recover. The growth was slow coming back. In this cycle, it was sharp at first when COVID hit, but the growth has been very high, much higher than normal, and with it, profits in stock prices. We're in a correction now, and those are generally defined as 10% drops in the market. If we were in deeper territory, like many of these other ones have been, you might actually tip over into a bear market, which is generally defined as being down 20%. Right now, we're in a situation where parts of the market are down 20%, and that's often a bad sign, but the overall market is down a little bit less. So we think this long-term idea that, these recoveries come about and time is on your side are what call for patience in these situations. Let's go on to the next slide. We also like to, that's a Barbara Mandel song, I was country when country wasn't cool, is her other famous song, but that's one of her songs quoted up there. I can easily get distracted by the country music song. I hope it doesn't trouble you to hear that. But we use these instruments to provide some ballast, some protection in portfolios, different amounts depending on the client's risk tolerance and other factors. Bonds have been the traditional safety net. When interest rates are rising, they become less. That doesn't work as well for bonds, and bonds are, not been a very good alternative lately. So we've used them less than we would in those prior cycles. Dividend-paying stocks have always been good, and they're good because the dividend-paying stocks are paying out dividends to you, but they also have profits with which to pay out the dividends. And so they are great ballast. They tend to be more like what some people call blue chips or well-established companies like Coca-Cola or other companies that have a long history of profit and paying dividends. We're more interested lately in some other kinds of ballast or safety. There's infrastructure investment. Infrastructure investment in the private sector is mostly international. It's done more in Europe. Privately funded infrastructure. Private companies build airports in Europe. We use the federal government in the United States to build airports, just as one example. And they produce long-term, fairly steady cash flow. So they have to generate that out of the uses of the infrastructure or the tolls. And we like that as a form of additional safety. REITs are commercial real estate, not residential real estate. That's something different. But commercial real estate that is in high quality areas. It can be retail, it can be commercial, it can be all different kinds of real estate. Those pay out 90% of the rent they receive in those REIT securities. And those securities are priced every day. They're not illiquid real estate that you got to go to somebody and advertise to sell the property for months or weeks. They're liquid. You can get your money the next day. So we like that. And then the really star lately has been Treasury inflation protected securities. Those are safe Treasury bonds. But if inflation goes up 7%, you've got $1,000 bond, they put the 7% in your repayment. You get more than $1,000 back. It adjusts for inflation based on the CPI. So those are a great form of ballast, especially in this current uncertainty about inflation. So these are some of the tools we're using, and these become important in volatile periods. We're ready for the next slide. These are definitions. I don't want to go through all of them. For those of you that look at the slides later, you can study these a little bit. That middle one is, Amanda's already talked about the inverted yield curve, but that middle one is the one that causes real worry. Stagflation, we had that in the 70s. That's when economic growth is slow, unemployment is high, and inflation is high. Like it's like a triple bomb. Right now, we don't have that. Economic growth is really strong. Unemployment is relatively low. It was high, a year or so ago, and but inflation is flashing red. So if that were to spread to slower economic growth, that would happen in a recession, or higher unemployment. We could get caught in stagflation, which is very difficult to deal with. It's difficult to get out of. It affects profits and it affects stocks. So that's the danger sign on the horizon. We're not predicting it's going to happen, but we're watching for signs of it. And at that point, we would probably want to be a little more cautious. The cycle of fear is like the cycle of inflation. And the inflation psychology tends to feed on itself. So I kind of changed the slide we used before about inflation to the cycle of fear. This happens, and we hate to see people get caught up in it. A market correction headline can look really bad, and you can feel it when you look at your monthly statement, or you just look at your statement on the internet. It can create the first step of the cycle of fear. What happens in these cycles is sales and advertising budgets go up for those people that are selling stuff they think might be lend itself to a little gloom and doom. Let's scare people a little bit, so they'll buy this speculative so-called investment, and that compounds the fear. It builds on it, and then you get crypto is one of those, by the way. And then you get a bandwagon effect, which makes the speculative junk look like it's a great alternative, because it'll be volatile, it'll go up. And so this is a thing that we think it's best to avoid. That's why we believe patience is the best thing. And that's a great George Strait song up at the top, by the way, there, for those of you that like all my exes live in Texas. So there you go. The gambler, know when to hold them, know when to fold them, is also important. We think, fold them, use your mute button, turn some of that stuff off. It's speculative. They're often poor choices. We've already had a question about bad stuff on social media, misinformation. Crypto is part of that. It's kind of trying to fill the place that gold has done in the past. Gold has been a speculative commodity metal. It's up now. It's done pretty good lately. We don't have a big problem with gold as we do with crypto because it's more traditional, but you can have too much of it. Market timing devices, we've experienced those with some of our pension clients. We had a pension client that bought a market timing service and paid money for it. And they sold, this firm sold their entire stock market holdings every day. Or the next day, they might buy the whole stock market. Like take 100% of your money out of the market one day, 100% back in the next day, 100% out the next day. You try to market time the days. When are you going to make money by playing the days? It didn't work. They lost a lot of money, and we've seen it. It's just hard to do. It's hard to know when to come out of the market. It's hard to know when to go back in when you're doing it like that. Meme stocks, some people have gotten caught in those as much as we like, AMC theaters, that stock going up and down and driving people crazy when it really had no earnings in a recession was not the best thing to be doing. There are a lot of real estate brokers trying to get you to buy more expensive and bigger and better real estate, like it's an investment. It's not an investment, it's a personal needs asset. And we're in a frothy real estate market right now. Be careful about that. You gotta have a place to live. You want a place to live close to where you work, and you want to have a nice place. But most of those are personal preferences, not investment preferences. You want to invest in real estate, buy commercial real estate in REITs. Long term, it produces really good returns. Residential real estate, most of the time, does not, although it's a little deceptive because the locations can fool you. Because one location may do good, and the brokers talk that up like everything is happening that way when it's not really true. There are many other fads out there. Just be careful about them. This is a time to stay to the fundamentals, stay with the fundamentals. The fundamental of the stock market is that good corporate managers make money with their companies. And what do they do with the money? They pay you part of it in a dividend, but what they do with the rest is really important. And it's on the next slide. They compound the earnings. They take that money they made and they reinvest it in their own company and their own operations, and they're good at it. They compound at very high rates of return. That's why stocks go up. That's why they're worth a lot more, is because of that compounding effect of earnings. And that's a fundamental thing. Measurable profits are important. And we get a better job of that in the domestic stock market than in some foreign markets where the accounting systems are not quite as great. We're so glad to have Emily, a CPA, working with us because, those standards of the accounting profession in the United States create this measurable profit that enables investors to transparently see what's going on. Free cash flow is important. We've seen a few companies when interest rates were real low, go to the bond market, borrow money real cheap, and then pay it out as dividends. In other words, they're not taking profits and paying you dividends. They're taking borrowed money and paying you dividends. They're manipulating the stock market to make their stock go up and look like it's good. So look at the free cash flow. Not free cash flow is what they're generating from their own profits and their own operations. And those are fundamentals. That's what we're trying to look at. Let's don't leave that yet, because there's two other key points here. Time in the market's your ally, not timing the market. It's a key fundamental idea. And Warren Buffett has a key fundamental idea. No one ever bet against America, he says, and its economy. And he's been investing since the 1930s, and by the way, done very well. So we always pay attention to what he says. Okay, I'm ready to move on here. Here's where you may need to reconsider. I kind of gave the example in the discussion part there. If things are looking worse than you expected and you're having trouble sleeping at night, it may mean you thought, or we thought, you had more risk tolerance than you really do have. So this may be an important time to reconsider that. It's like getting a wake-up call, And so if we want people to be patient and stay the course, but if you need to adjust risk tolerance, we can do that. And we're doing that with some people where that's happened. Time horizon is especially important. If you need the money in less than 5 years, you ought to have some ballast. You ought to have some bonds, even if they don't pay as much as the stock market. If you've got 10, 20 years, get in there full bore. Time will be your ally. And ultimately, it's always about your goals and how you achieve your goals. So those things we always try to pay attention to. I'm going to quit filibustering on, I think, because that's my last slide, but we do have a question here. And the question is, what of these ideas would you like to hear more? And I hope you say, you want to hear a little country music and not be too worried about the market.
Sorry, it took me a minute. A little rusty. I feel like we should all know Zoom in and out by now, but there's always something. So everybody should be able to see the poll now. Hopefully, I'll leave it on for a minute before and then I'll close. I have to close it to launch it to see the results. So somebody voted so far for why David likes country music. Okay, I'm gonna go ahead and close out the poll. I think
That
everybody.
makes me happy.
Oh, really? I can't see who did it, but can everybody see it now?
Future
Okay.
focus during tough periods. That's a really good, I like that response. I hope we haven't squeezed Danielle too. Danielle's our cleanup hitter, and always in the webinars, the rest of us tend to talk too much and kind of squeeze Danielle's time. So I'm gonna be.
I always see that 7 voted. Is everybody not voting? Come on, y'all.
Yeah, some people didn't vote.
All right. I would vote if I could. I can't vote.
Yeah, we don't. We're not voting. Part of that.
All right, so Amanda's done a great job talking about why the market looks the way it does this quarter, and David's gone on to talk about what we do about it as advisors in the portfolio itself, what the government does to try to keep the assets from doing something horrible, or just taking advantage of what the next part of the cycle is going to be. And the part that I want to talk about is it's really planning, basically tax and financial planning. It's the part that I really like to do. We're going to go back to fun 80s songs, not country 80s songs. So on the first, I grabbed 4 things. Whenever the market is down, I automatically think, what of these things can I be doing today? I see red and I'm like, oh, good, it's a good buying day. Like as an advisor, that's what I do. I go and look and see who's been depositing cash and get that cash invested. So on the next slide, I'm going to show specifically talking about when prices are low. Amanda found this great chart. I know it's a lot of stuff going on, but the gist is that each of those bars or each of those columns is a year. This graph goes all the way back to 1980 and it goes through the end of last year, 2021. And you can see that each and every year has a low. That red dot with that yucky number below it is the low in the S&P 500 for that year. And the S&P 500 is the top 500 companies, the largest 500 companies in the United States. And it's just one of those easy things we graph. So you certainly own a lot more than that in your portfolio. But I wanted to show you that every year there's a low. I remember some years ago it stood out. Some headline came out and it said, this is the worst day in the market this month. And I was like, well, there's a worse day in the market every month. This is not something to get upset about. And so I just wanted to remind everybody, again, back to that normalcy and that sort of thing continues to happen. If you look at the last 40 years, you'll see that in most cases outside of the dot-com bubble period from 2000 to 2002, those negative periods are often followed by a positive period. That's not guaranteed. It's not always going to happen, but in history, in our recent history, that is what's happened. And I did the math. I averaged out what the annual bottom is for each year. And in the next slide, because I can't remember, it's 12.6. So the average down period in any given year in the S&P 500 is about 12.6. I grabbed the last 13, 14 years here. I started with the 2008 subprime mortgage crisis number there, that god-awful number there at the bottom, and through last year. And I wanted to show that for the last 14 years, that average bottom has gotten much bigger. Our average now is about 17.2. That goes again to that volatility that we've been talking about. We have much higher highs, much lower lows, but it's just something that we, at some point, we're just going to have to accept, because that seems to be what's happening. Again, I'm not going to go into why and all of that. We don't really have time for it. I just wanted to point out that is happening, and it's starting to happen more frequently. So when I talk about buying low, a lot of folks do that anyway by having a monthly contribution to their 401k or their Roth IRA. That is a great way of doing what's called dollar cost averaging. You take those high highs and those low lows, and you kind of start to compress them by investing throughout the period every time there's a high and a low anyway, and without regard for what day it is. It tends to even out those numbers. I had a lot of folks in the last 6 weeks max out their Roth contribution for 2021. It was a great quarter to do it. They got to get in there while those prices were low. If you've got a little extra cash built up, this might be a good time to get some of it in. It's one of the oldest adages, buy low. So that's our first opportunity in a down market. The next opportunity comes this is not for retirement accounts. This is for taxable savings, and that is called tax loss harvesting. That means that you purposely sell a security while it is down or while it is pressed from where it was a little bit before, so that you can offset gains in something else. Capital gains rates, I've listed all of them there. I'm not going to go through them today, but it's important to note that there's a lot of people who actually pay 0% long-term capital gains on investments. Again, this is a strategy. This is something you want to keep in mind and talk to your tax professional about, talk to us about. Most folks are in the 15% bracket for long-term gains. If you've held a security for at least 1 year and you need to sell it at a gain, you're only going to pay 15% on the portion of that that is a gain. And so I threw in an example because I think examples are helpful. Lucy from I Love Lucy wants to do a real estate project. She's buying some land and needs to build a building and do something for a project. And in order to do that, she sold in January $150,000 worth of ABC stock. It produced a gain, a long-term gain of 50% at 15% taxes. She had to pay $7,500. Well, Lucy is now cash poor. She's put all of her money into this real estate endeavor that she's doing. So she needs to get the $7,500 from somewhere else. And in April of the same year, the market's down and she's able to sell $7,500 of her S&P 500 index fund at a loss of $500. And that offsets how much she has to pay in taxes. So instead of paying $7,500, she pays $7,000. She doesn't owe anything else. In fact, she nets $500 on the transaction. She listened to her advisor at Propel, and she reinvested it through a backdoor Roth that she will never pay taxes on again. So there's always all of these things going on that could be helpful whenever something in your life that we don't all live in a vacuum. If something is happening and you need money right now, talk to us. We know what we're doing. We can look at what's going on and we can make suggestions based on these sorts of strategies. The next concept is Roth conversions. We beat Roths to death. We love them. Just in the last couple of years, I feel like people are finally listening, which is really rewarding. I'm not going to read all of this to you. It's here on the slides if you get a copy to look at it. A reminder that traditional IRAs and 401ks are called pre-tax retirement accounts. You've probably never paid any taxes on them. So when you take money out of them, you will be taxed. The reason we like Roth IRAs so much is that once you get them in there, the IRS doesn't get any piece of it. So if you go to the next slide, a Roth conversion, and particularly why we like Roth conversions in down markets, is you're taking a security and you're moving it directly from an IRA or a 401k to the Roth account. We don't even have to sell it. We don't have to change anything. We have to report it. You're going to get a 1099-R for the value of that security that you moved over to the Roth. But then that's it. It's done. You won't pay taxes on it anymore. And for instance, I did a Roth conversion just the other day, and I decided to move ARC ETF, which is down ridiculous amounts of money for the last 6 months. And then it went back up. So the up that the client experienced in the Roth is not going to be taxed. And so down markets are a great time to do that. You might say, I want to convert $10,000, and 6 months later you realize, hey, I actually converted $12,000, but I didn't have to pay tax on 2 of it. So doing routine Roth conversions is a really good idea, especially if you have way too much in your IRA. Remember that Congress, in its infinite wisdom, a couple of years ago decided that beneficiaries of IRAs, if they're not your spouse, should withdraw all of that money within 10 years. It took you 40 or 50 to save it, but your beneficiary should take it all out in 10 years and pay taxes. It's a really big deal. It's a huge change. And so Roth conversions, as long as they're allowed, are going to continue to be a much more important part of your planning. Emily's telling everybody we can leave. Okay, so the benefits again are your Roth conversion is taxable, but you're going to be paying the taxes on your income. You're getting income every month. Don't take that for granted. When you're retired, that stops. So we don't want to pay taxes out of a finite bucket of savings. We want to take it from that replenished income that we have. It's just something you need to budget for. It stops the tax on the earnings, and it creates a tax-free source of income when you're older. And again, there's no more income coming in. We don't want to be tapping your retirement, and we don't want to increase your adjusted gross income on your tax return. Your Roth IRA distributions are invisible, and it's a really big deal. I want to point out that Roth conversions are not for everyone in every year. They require very careful planning, so you need to talk to us and your tax preparer before you do them. But back on the original IRAs, you will take that money out and you will get taxed on it. So the Roth conversion gives you a chance to spread that tax out over several years versus maybe just a handful of years. Oh yeah, I always throw this in. I always forget about it. If you live in a state that is not one of these states, you will be paying some sort of tax on your retirement distribution. So keep that in mind. It's another thing that you have to worry about in the future. If you wait until you're retired to start taking money out of your IRA, not only do you have to worry about the IRS, you have to worry about the state. So I just want to remind everybody about that, because honestly, as a tax preparer and advisor, sometimes I forget about state taxes too. All right, last but not least, challenges spur action. If things are going well, you tend to just kind of ride along and not do as much. Stress causes people to get creative. It causes people to think, to remember, to grow. And we see a lot of that in the government, in corporations, and in individual planning when markets are in down periods. And I think that's a positive. We don't want to keep thinking and keep coming up with new ways and new ideas, and that's a positive thing. And one way to do that is to do a formal financial plan. We've seen a lot more of it in the last, can you go to the next slide, Amanda? We've seen a lot more of it in the past 18 months since COVID. It did a lot for priorities and thoughts and planning needs for people. And that was a really good byproduct of a tough time. A formal financial plan means we have a meeting, we pull a lot of your thoughts, your aspirations, your goals. I hear a lot like, well, my goal is just to save as much money as I can. And that's a good goal, but it is not quantified, it's not measurable. We recommend putting it on paper to set those goals. And once you have those goals, and once you kind of know what your picture looks like with real numbers and charts and colors and all kinds of neat things, it's a good source of motivation. It keeps you committed. It's a good way of staying active and making good decisions, and setting performance standards for what you can handle. David talked earlier about what your risk tolerance is. You might say, well, I'm not comfortable losing money, but if you leave way too much money in cash, you're losing money in just a different way, because you may run out of money. Also, having a financial plan and working with somebody takes some of the emotion out of it. When these tough periods happen, you think, okay, what can we do now? What should we do different, if anything? And studies have shown that having formal financial plans improves financial outcomes for all of those reasons. Amanda was quick to point out that for married couples who may not always agree on their finances, this is a really good way for somebody outside of your marriage to help you find common ground, to take your differing views and find some commonalities and find something that makes sense for you as a couple too. That is all I had. Does anybody have any questions on that? All right, I've got my last poll too, I think. So out of these market opportunities that we discussed, what do you want to learn more about, or what do you think you need to take advantage of?
We should do a poll on what people's favorite songs are out of this.
Yeah, why didn't we do that?
Missed opportunity.
You can put it in the chat.
Yeah, feel free.
I mean, I thought it was fun to add the songs to our slides. You know?
Well, it was fun for us. We were all
Yeah.
singing 80s songs all week, and we were sharing them with each other. So that was kind of fun.
Yeah.
And maybe while we're leaving this up for a few more seconds, I'll take this opportunity to plug our podcast. It's something Amanda and I have been working on for the past several months. David and Danielle have both been on, and it's just a nice little, less formal way of talking about things that come up in the financial markets, and also some personal finance topics. It's called Connecting the Dollars, and you can find links on our website. And yeah, if anyone's interested and can't find it, just let me know.
What's the next one, Emily?
The next one? Oh, the next.
What's the next podcast?
The next podcast is going to be about the housing market. So stay tuned for that.
Okay.
Well, good. Looks like 8 out of 12 responded to this one. That's good. Yeah, whenever you have questions on anything, just reach out to one of us or all of us, or info@propel-fa.com about things you want to talk more about. We enjoy doing these things. Thanks, Leslie. We like the song theme too. We always try to find some way to make it fun. This can be very dry. There's a lot of numbers, a lot of graphs, and we want to make it fun for you. So we hope that we managed to do that. Any other last questions or thoughts or suggestions for another webinar, or
we did get
else?
one question. So when I'm rich, where do I find the best monocles and top hats for an active lifestyle?
I don't know. I usually go to Amazon. I have no idea.
I mean, if you're rich, like you can just get a bespoke hat made, I'm sure.
Yeah, yeah.
Fancy monocles. All right. Well, there's the link to our podcast. I don't know where our picture went, but
Oh, I
anyway,
like the picture.
I think, yeah, I don't know.
that's all right.
All right.
Well, thank you, everyone.
Thanks, everybody. Have a good day, and let us know if we can do anything else.
For coming, everybody.